Welcome to Trader TV Crypto, your insight into the trading climate for professional cryptocurrency investors. I'm Dan Barnes. In March's show, we'll be talking with Nic Niedermowwe, CEO at Prime Factor Capital, about the challenges a buy-side trading desk faces in price formation and trade execution for cryptocurrency markets. Nic, welcome to Trader TV.
Thanks, Dan. Good to be on.
So, to start with, could you tell me, how do we define a cryptocurrency?
So cryptocurrencies are essentially the units of account on decentralized ledgers or blockchains.
Okay, and by blockchain we're talking about effectively a shared database of transactions, is that correct?
That's right. It's a peer-to-peer network that is essentially maintaining this shared database, and there is miners that ensure that this database is consistent. The vast majority of trading actually does take place on centralized exchanges.
Okay.
But there is some ideas at least and concepts out there to have decentralized exchanges as well that operate directly on the blockchain.
I see. So essentially the instruments are issued on the blockchain but can be traded on exchanges.
That's right, yeah.
I see, okay, that's very interesting. So if you're on the trading desk of an asset manager and you're engaging in the cryptocurrency market, what are the biggest risks that you face?
Yeah, I think one of the key things that is really quite unique to the asset class is the fact that you really have to maintain control of your private keys. This is essentially ensures that you maintain ownership of your cryptocurrencies.
Okay.
And we have seen numerous hacks, and they usually involve in compromising the security around the private keys and getting access to the addresses on the blockchain.
Okay, so that's interesting. In other securities, one would typically expect a custodian bank or a central securities depository to be holding that security on your behalf ultimately, but here the security is actually held by the asset manager.
Well, there is some specialist custodians that provide something that's called cold storage, where these private keys are kept on hardware modules that are disconnected, physically air-gapped from the internet, to really give you the security that you need if you're holding larger amounts of cryptocurrencies. However, these entities are typically not regulated, and we haven't seen traditional custodians, depositories moving into the space yet, being willing to accept these risks.
So how do you go about assessing liquidity, and does the potential fragmentation across different exchanges complicate that?
Yeah, it does. What you will find is that there can be large price differential between different exchanges. But we've also seen a number of service providers now springing up that kind of aggregate this data and make it available to you on their web pages or via dedicated APIs.
Okay, oh, that's very interesting. Are there any concerns about the quality of data or the extent to which one provider may be better than another?
Yeah, I think this huge fragmentation in the market can lead to some weird effects.
Okay.
So you would often see new exchanges springing up, others closing down. It's difficult to keep up with kind of the speed at which the market and the ecosystem as such is evolving.
Yeah.
So you always need to look at what's behind the data that you're actually seeing to make sure you're working with what you think you're working with.
So are all the data sources aggregators, or are there also, presumably you can use the exchanges and also brokers?
Yes, indeed. So over the past year, we've seen a whole number of brokerages and OTC trading desks popping up, mostly to serve the institutions that have entered the space now. There is over 200 hedge funds in the market now.
That's really interesting. That's quite a sizable number. And are the sell-side firms, both the traditional sell-side firms, the big brokers, and new sort of electronic liquidity providers? What's the measure of them?
No, it's mostly new entrants into the space.
Okay.
So really none of the established big brokerages, prime brokerages, have entered the space yet. So I think that's a development that we'll only see a couple of years down the line.
So what does the inclusion of both retail order flow and institutional order flow mean for the liquidity picture and the opportunities in the market?
Yeah, so far markets have been driven by retail investors. Not only in terms of price, but also in terms of volume. And this high volatility we have seen and these boom and bust cycles over the years That's certainly something to do with the fact that we have more retail investors than professional investors.
Sure.
That build their investment decisions on proper research. So this can be a distraction for those that take a longer term view on the market and expose them to risks. Whereas for traders, it can actually be an opportunity to benefit from the irrational behavior that we sometimes see from retail investors and turn that into profits and helping to dampen this volatility.
Talking about institutional trading, of course, one typically expects large asset managers to trade in blocks. And when trading blocks, one's concerned about information leakage. Can you trade in blocks now? What sort of size can you trade in? And is information leakage an issue?
Yeah, it is possible to trade blocks through brokerages. So they would be quoting a price, taking the risk that they can externalize these positions in the market.
Yep.
It's a highly volatile market, so it does require you to have a good view of what's going on to be able to take this risk.
Yeah.
So it's a convenient way for institutions to access liquidity.
Okay.
And we've also seen some alternative ways of doing this. For example, via algorithms that effectively do kind of some sort of smart order routing over longer periods of time. Trying to get around problems like information leakage, for example.
Just as we see in the equity markets.
Absolutely.
Okay. It strikes me then that there's another potential risk, which might be that the infrastructure one's trading on has to have the operational rigor to support institutional level trading and potentially spikes in volume. Is that a concern?
Yeah, absolutely. And I think that's still something that's lacking actually from the market.
Okay.
So hopefully that will improve over the course of the next few years as well. So again, one of the reasons or contributing factors, institutions have been slow to move into the space and are biding their time a little bit.
Sure. We have seen some of the larger exchanges move into the derivatives space and some talk about exchange traded products based on cryptocurrencies. How useful are derivatives and ETPs for taking risk on and off quickly?
Yeah, I think so far the usual way of trading was really in the spot markets, and some of the larger exchanges do offer leverage trading, so that's a convenient way of putting on and off risk.
Yep.
But obviously futures are very helpful in going short. That's something you can only do on an institutional grade infrastructure since last December. And we have now also a derivatives exchange in the US where you can trade swaps and options.
Yeah.
And I think the fact that regulators have been quite reasonable in the way, quite sensible in the way they approach the asset class, I think that can make us all hope that very soon we'll see the ecosystem thrive even more and a much wider range of products being available.
That's great, thank you. And then finally, what questions might an end investor who's looking to invest in the crypto funds typically ask of the trading desk of an asset manager?
Yeah, I think you want to make sure that they're on top of things operationally. I mean, it's a very fast-moving space. There is these security concerns for traders as well. When you're trading cryptos, that by definition means they're no longer in cold storage, so they are exposed to potential hacks. And of course, you do have counterparty risk. Exchanges in the crypto space are not proper regulated exchanges. They're trading platforms. So do make sure you understand what risks you're taking with your counterparties, and also the market risks can be larger than you're used to from other asset classes, with volatility for cryptos in the past year having been about a factor of 10 of the S&P 500.
That's great. Nick, thank you very much.
Thanks for having me, Dan.
I'd like to thank Nic Niedermowwe, CEO at Prime Factor Capital, for those insights into trading cryptocurrency. To catch our report on fixed income markets this month or to subscribe, go to tradertv.net.